Wells Fargo and JPMorgan earnings are on deck for tomorrow. Mortgage rates continue to skyrocket, and David and I, well, we're placing some bets. Buckle your seatbelts, folks, because this is where the money is.
Matt, you mentioned in the intro that interest rates skyrocketing. Earnings tomorrow for some of the banks. Is it going to be a bloodbath? What do you think?
I think in some ways we're going to see some big hits on the banks, in particular on the balance sheet. All of the banks right now have huge security portfolios. Most of that is fixed income. When rates go up, prices go down in the fixed income market. That's going to lead to losses on the book. And since we value bank stocks based on book value multiples, that has an impact on valuation.
Yeah, I'm certainly going to be watching OCI as well. I'm also going to be looking at some of the things above the line, particularly mortgage banking. You look at Wells Fargo, JPMorgan, these two are 1 and 2 in terms of mortgage originations in the US. And with rising interest rates, refinancing, which has been the big driver behind a lot of these gains, has been falling off a cliff. I think it's down around 50% from, that's the Mortgage Bankers Association Refi Index. That's down around 50% over the last 9 weeks or so. So it's going to be very interesting to see how these banks handle that and how they make comments in terms of what's going to be the environment going forward. It's going to be very interesting to see.
So you're talking about mortgage banking fees. That's on the income statement, so that's going to hurt profits. I'm talking about the balance sheet. We're going to have some hits to the balance sheet. That's going to hurt book value. Is there any positives that we might see tomorrow?
I think so. If you talk about the balance sheet, the other thing I'm going to be watching is loan demand. Are people borrowing? Rates went up. And in order for these banks to benefit from rising rates, they need to make loans at these higher rates. And last quarter, Marianne Lake, the CFO of JPMorgan, she said, she was answering the question, why is loan demand and loan growth low? Why is it so sluggish? And she chalked it up to, yes, demand's a little bit low, but JPMorgan was also sitting on the sidelines a little bit because they weren't super comfortable making loans at record low rates. So it'll be interesting to see what they say about that going forward. Were they more active as rates went up? And it'll also be interesting to see, is Wells Fargo, are they in the same camp, or are there differing opinions about what does the future look for the loan environment between Wells Fargo and JPMorgan?
Interest rate spreads, that is the positive I'm going to be looking for. I think that spreads may have seen some benefit from this, and that actually segues us into the next subject. Freddie Mac, a report from Freddie Mac, this is a weekly report that shows the average conventional 30-year mortgage rate continues to rise, week over week continues to rise, but the most marked rise we've seen is if we look at this on a year-over-year basis, the 30-year fixed mortgage is up almost 100 basis points. That is gigantic. I mean, if you're a home buyer out there thinking about buying a home, 100 basis points difference in how much you're going to be paying on your 30-year fixed, that's gigantic. For the banks, it could be a benefit. One of the things that I've been looking at is the difference in the movement between the 30-year fixed mortgage rate and actually some other lending interest rates versus the rates that banks are paying on CDs and on money market accounts. CDs and money market accounts, those aren't really going anywhere. Those rates aren't really moving yet. They'll probably move at some point with all rates going up. But we're seeing mortgage rates take off. And it's within that spread that the banks make their money. It's the spread between what they're getting for what they're lending out and what they're paying to borrow. And you look at a bank like Bank of America, it's got twice the amount of interest-bearing deposits as non-interest-bearing deposits. Obviously, they're not paying anything on non-interest-bearing deposits, so it doesn't matter. So those interest-bearing deposits, the cost of those isn't really changing very much right now, but what they're potentially getting on loans and other securities that they're taking on their books is going up. So this is good for Bank of America. This is good for Wells Fargo and JPMorgan. What I like about Bank of America a little bit more right now is that they lagged everybody else collecting the fees on mortgage origination. So they're going to see maybe a little bit less of a hit there, where you look at Wells Fargo and JPMorgan, they were killing it. They were head and shoulders above everybody else, way beyond Bank of America. So they're going to be hurting on that aspect this quarter. Bank of America, maybe not so much so.
So if the banks are benefiting from this wider spread, collecting it on those longer dated securities and loans, and still not paying out a lot to their customers in those CDs, money market accounts, does that mean customers are losing? People that are maybe in the market for a new home to get a mortgage, are those people losing?
Well, losing is I think a little bit of perspective is due here because we're in the mid 4% range for a 30-year fixed mortgage. If we look back just 5 years, if we look back 10 years, 4.5% 30-year fixed mortgage would have been considered a dream. So the problem is for home buyers is that if you compare that to the 3.5% that you get this time last year, it looks terrible. But on a grander scale, it's pretty good. Now the question is, does that matter? Does it matter that in the bigger picture, 4.5% is still a good rate? Maybe not. That may impact demand. That may hurt home builders. Home builders may see demand start to drop. Mortgage originators may continue to see demand start to drop because people are fixed on that 3.5% is a good rate, 4.5% not so much.
Yeah, and I'm in the camp that thinks it's not going to be a very good thing for consumers, especially because since the crisis, yes, we've seen the stock market return to record highs, but the average American, their incomes aren't growing that fast. So they're still lagging behind, especially when we see mortgage rates tick up and average Americans are still kind of stuck where they are. Their income isn't growing as quickly. I think they stand to lose in that situation a little bit.
Potentially so. Now, thinking about the recovery from the crisis and whether banks are going to have to look for bailouts again, are going to get hurt again, we've got this issue of capital. And yesterday on this show, we were talking about new Federal Reserve. It's a combo rule, Federal Reserve, Office of the Comptroller of the Currency, and the FDIC all getting together.
It's a big party.
Rule. Yeah, it's a big party. New rule, higher capital ratios. And you know what? To some extent, even for us, we follow this kind of stuff all the time. For bank analysts that are outside of these walls, it's really difficult and tricky to navigate these risk-weighted assets. What is Tier 1 capital versus Tier 2 capital? What's a leverage ratio versus just a regular Tier 1 capital ratio? It can make your head swim. So I was looking at some numbers yesterday, and I think a much simpler way for investors to look at this in terms of how well capitalized is the bank that I'm investing in is to simply take tangible equity and divide that by total assets. Now, tangible equity, of course, you look at that book value, the shareholders' equity number, and you deduct any non-tangible assets on the balance sheet. So non-tangible assets, that's goodwill, and then often they'll label it really nicely for you and just say other intangible assets. So you take both of those out of equity, and then you divide that tangible equity by total assets, and you'll get to a percentage. Here's the interesting thing that I saw looking back to the end of 2007. I'm going to rattle off a few names here. Remembering any particular name isn't as important as the big picture. So Merrill Lynch, that percentage was 2.2%. Lehman Brothers, 2.5%. Citigroup, 2.7%. Bear Stearns, 2.9%. Bank of America, 3.2%. And Wachovia, 3.7%.
Those all have something in common.
The median for that ratio, that tangible equity to assets ratio at the end of 2007 for the biggest banks was 4.6%. So all of these banks were below the median. And when we look at, like I said, Merrill at 2.2% and Lehman at 2.5%, Citigroup down there, Bank of America down there, they're all well below the median. And they all ran into big troubles when their capital was challenged. On the other hand, we look at JPMorgan and US Bancorp. At the time, were at the median at 4.6%. They saw far fewer problems as the other banks. Wells Fargo at 5.9%, well above the median. Wells Fargo skated through. In fact, Dick Kovacevic, who was the CEO of Wells Fargo at the time, argued vociferously against taking bailout money because Wells Fargo didn't need it.
Right.
And when you look at this ratio in comparison to everybody else, you can see that Wells Fargo was far better capitalized. BB&T, another bank, 5.2%, well above that median. So then what I did was I looked at today. So what are among the biggest banks today, who is the best capitalized based on this ratio? KeyCorp was way up there at the top at 10%. And I should say that the median, when we think about banks changing between pre-crisis and today, this is pretty telling. The median of this ratio went from 4.6% in 2007 to 7.5% today.
Wow.
So across the board, banks have become better capitalized. But KeyCorp, 10%, way up there. Huntington Bank shares at 8.8%, way up there. Citigroup one of the best on this ratio, one of the best capitalized banks at 8.5%. And then the other thing that I looked at is the delta. So when we look at 2007 to today, if we think about those banks that were, potentially we can consider undercapitalized if they were below that median point in 2007, who made the biggest change? Citigroup. Biggest change overall, 5.8% delta, 5.8% change. PNC Bank made a big change. Huntington Bank shares made a big change. So again, we hear all of this about capital levels and ratios, and there are a lot of calculations that we just can't do. We can't sit here and do the risk-weighted assets calculation that's going on at Bank of America. Mm-hmm. But what we can do is we can sit down and we can look at tangible equity versus assets. And I think that this, for shareholders, for investors, this is a pretty good measure to be able to look at how well capitalized a bank is without getting into those crazy numbers.
Absolutely.
All right. Now, after that, moving on from that, let's go to one of the big concerns this quarter for bank earnings is mortgage fees.
Right.
And we look at JPMorgan and we look at Wells Fargo, who lead the U.S. in mortgage originations. We're expecting that their fee income is going to get hurt because of the drop-off in mortgage originations. But what exactly does this mean? What are we specifically talking about when we say the fee income from mortgages?
Yeah, so Wells Fargo and JPMorgan, they both total it up to mortgage banking income, but it's really two distinct parts of what makes up mortgage banking income. So if we think about walking into your mortgage broker, going through the whole process, getting the mortgage, the bank will turn around and sell that mortgage typically to Fannie Mae or Freddie Mac, who control roughly 90% of the mortgage market now. Mm-hmm. So once they sell that off, they record a gain on that sale of your mortgage. But once Fannie Mae takes that mortgage and they bundle it and make it into mortgage-backed securities, they still need a bank and a servicer to service that mortgage and deal with the whole, kind of the back office function of dealing with that mortgage. And we look at a bank like Wells Fargo, I think their portfolio of what they service for other investors and other people that hold those mortgages that they originated is almost $2 trillion in mortgages. So
that's who the end user, who the mortgager is actually sending their payment to.
Correct.
So even if Wells Fargo sells the mortgage to Fannie Mae, you're not sending your mortgage payment to Fannie Mae. You're still sending it to Wells Fargo, and that's what they mean by servicing it.
Right. And since they're servicing it, they demand a fee from those investors, who is ultimately getting the payment at the end of the day. But Wells Fargo is kind of the middleman between the consumer, you and I, sending our payment to Wells Fargo, and then they deal with the servicing. So they get a fee from that. They also get a fee from actually selling it to Fannie Mae or the other private entity if they decide to sell it off their books. So those are the two main drivers of what that line will be when we see total mortgage banking income.
Okay, so not to get too wonky here, but when we talk about that mortgage servicing income, the way the banks deal with that is it's not we get this fee income on an ongoing basis and that's what's running through our income statement and showing up on our profit line. They actually they assume, well, we're going to get this expected stream of payments over the life of all of these mortgages, and they discount it back to what they believe it's worth today. And then that's an asset on the balance sheet. And so the changes in mortgage rates and everything else and the income that they actually get, that changes the value of the mortgage servicing rights portfolio. And that's where it gets a little bit confusing. So it's not mortgage servicing fees that they're recognizing, it's changes in the value of this portfolio.
Right.
So again, just to wrap up what you were saying, we've got the fees for selling mortgages that they originate on the one hand, and then changes in the mortgage servicing rights portfolio.
Right.
And I think as we've said already a couple times, the mortgage origination fees, those are almost certainly going to go down this quarter. The mortgage servicing rights portfolio, however, there's the potential based on how the banks hedge that could actually show gains this quarter.
Right, and because when we think of that, the mortgage servicing rights, the main driver behind that is interest rates, whether they go up or down, and the second leg of that is people repaying their mortgages. So if you and I prepay our mortgage and Wells Fargo is making income off of us, and we prepay, they don't get that income anymore. So it changes the value of the rights there. So like you said, the gains on the sales, those will probably go down as activity goes down. The other ones, it's a little bit more of a juggling game between what are interest rates actually doing. And especially the second quarter, they've been very volatile. So it'll be very interesting to see how has that changed at each of these banks.
Okay. Finally, looking ahead to tomorrow, JPMorgan, Wells Fargo, reporting earnings. let's put something on the line here, David.
It's been a while.
Let's lay down a bet. Which stock do you think is going to perform better tomorrow in reaction to its earnings, Wells Fargo or JPMorgan? And let's put a Starbucks coffee on the line here. None of your fancy schmancy stuff.
Straight black coffee.
Regular coffee. Just to be clear, which bank stock is going to perform better in reaction to earnings?
Going to go conservative, going to side with Mr. Buffett. I'm going to go with Wells Fargo. Yes, there's concerns over the mortgage business, as we've discussed extensively in the show today. That is a concern, but I really think Wells Fargo, they have the management team to manage through a volatile interest rate environment like we've seen in the second quarter. I think have a proven track record that they'll hedge appropriately, they'll scale back businesses when they need to. So I'm putting my faith that Wells Fargo managed this, and I think the market may be discounting that a little bit. So I think Wells Fargo, that stock is going to trade higher than JPMorgan.
I'm going to go with JPMorgan, not just because I have to, because I want to. JPMorgan has more capital markets exposure than Wells Fargo, and I think as we look towards the impact from the mortgage market this quarter, I think that the capital markets department at JPMorgan has a chance to offset some of that. Mm-hmm. And with the rising rates over the last quarter, I mean, it's been a pretty drastic rise. I think maybe that could be additive. There could have been some extra activity in the trading group at JPMorgan, which would produce more profits there. In addition, when I look at the valuation of JPMorgan today, I think that valuation takes in way too much pessimism. Really doesn't look at the value of JPMorgan, the company today, versus Wells Fargo, which is valued considerably higher than JPMorgan. So when I look at the two of them, I think that there's more opportunity for investors to say, hey, JPMorgan is better than I thought it was, versus Wells Fargo, where they say, I thought this was really great, and maybe it's kind of falling short of my expectations.
We'll find out at 4 o'clock tomorrow.
All right. For David Hanson, I'm Matt Koppenheffer. Thanks for watching.